Hello, everyone. I'm Serkan Bahçeci. I am the head of research at Arjun Infrastructure. As a research person, I quite often look at the long-term trends, of course, relevant to infrastructure. And I would like to talk about the current macroeconomic environment, where it fits in the longer time frame, and of course, the implications for infrastructure investments. I'm going to say the overwhelming macroeconomic trend these days is the diminishing population growth rates. They are diminishing everywhere globally. The population growth rates are negative already in many countries, especially in the West, in the OECD, and it is a fundamental change. It has never happened before since at least the Industrial Revolution, and maybe even we can go back to the Ice Age. We are used to this ever-increasing populations for the modern economies to function, and we need to stop and think how the world is going to act when it comes to demand and supply, especially going forward. A decade of 3 to 5% annual GDP growth rates, that's not coming back, which was the norm in the 50s and the 60s. It was expected up until quite recently, but it's not going to happen again because in the end, GDP growth rate is labor force growth plus productivity, and that labor force growth is diminishing. The implication is that the GDP growth rates will be low. That's the long-term trend, but that low growth means weak demand, a lot of political turmoil, an elevated level of risk. We need to take that into account. A rosy decade, since that's not going to happen, that will create a lot of conflict. Keep that in mind, heightened level of volatility. Okay, an implication of that weak demand and the low GDP growth rates is the increased need for the central bank support, accommodative monetary policy, in short, low rates for long. I think it goes against the consensus, though I'm not sure what the consensus is exactly on the interest rates, which are high now. But my personal view is that at least the policy rates that the central banks are announcing, they will fall below inflation, back to the negative real rate territory that we had in the pre-COVID era. Because of the weak growth rates, the economies will need that support. There will be political pressure, even though we expect the central banks to be independent, they will cave in, they will lower the rates. How much time that's going to take, no one knows, but I think it's a good case, at least a scenario, a macroeconomic scenario that we all need to consider, low rates for long. Which brings us to the return expectations in the infrastructure space, or actually in any other asset class for that matter. Interest rates rose 300 basis points quite recently, as everyone knows. That was for the first time for a while, since the mid-80s. That taught us a few lessons here and there. The nominal expected returns have also increased, or should have increased. The valuation discount rates have increased, or should have increased. If they haven't, you need to go back and check your portfolio again. And if I'm right on the interest rate, forward-looking interest rate curve, they will fall again. The interest rates will decline, as well as the nominal returns, as well as the valuation discount rates. That volatility, that changing the nominal rate expected returns, we should be quite careful. And actually, if you think about it, and this is economics or maybe finance 101, we should think in terms of real returns rather than the nominal ones. When I say real returns, it should be an inflation-adjusted expected return, or if we want to take a step further, it should be an equity risk premium, depending on, of course, the risk profile. So what is the appropriate equity risk premium for infrastructure? The economist's answer is it depends. Of course, it depends on the risk profile. The way I define core infrastructure boils down to that. and the magic number is 7%. If we target a 7% equity risk premium in the infrastructure space, that's premium over the risk-free rate or the 10-year government bond yields, if you think about it, or a range around it. It doesn't need to be 7, clearly. We can fulfill the premise of infrastructure. It makes our life quite easy when it comes to all that high and stable yield, low volatility due to low loan-to-value ratios, inflation protection, low correlation to all other asset classes, and so on and so forth. On the core space, a 7% equity risk premium allows us to do that. If you push it a bit forward, we are increasing the risk, especially in terms of the exposure to the capital market volatility, which will be at a heightened level, if I'm right, and if there's going to be an increased level of volatility going forward due to the low GDP growth rates.